Right now, something rare is happening in the EV world. The story behind NIO is splitting. On one side, you have record deliveries, new technical milestones, and deep ecosystem expansion. On the other hand, the stock barely reflects any of it and even faces serious execution risks. If you've been wondering why NIO's share price isn't soaring with that kind of progress and what real factors matter next, you're going to want to hear this. Let's open with the strongest signal in the last month: deliveries. NIO reported 27,182 vehicles delivered in January 2026, a massive 96.1% year-over-year increase, pushing its cumulative deliveries over 1 million units for the first time. That's not just a one-brand story either. This includes units from the premium NIO brand, family-oriented Anvo, and compact higher-end Firefly models, showing demand across segments. That kind of delivery growth is a fundamental catalyst EV investors love to see. It means the products are selling, customers are choosing the brand, and production scale is real. It's the kind of metric that built confident investor narratives at other companies before massive re-ratings occurred. But here's where the truth splits. Despite this operational achievement, NIO's stock has traded modestly and remains far below previous highs. That inconsistency is where the truth clash between bulls and bears gets real. On the bullish side, deliveries exploding and cumulative units crossing the million mark signal that NIO isn't just surviving, it's growing meaningfully. That's a foundational success story few would have confidently predicted just a year ago. Add to that NIO's continued investment in smart EV tech, including software upgrades and battery swapping infrastructure, and you start to see a long-term execution narrative forming. But momentum in deliveries hasn't moved the stock in lockstep, and that tells you something important. Operational progress doesn't instantly translate to shareholder gains. The bears have a case here, and it's not a flimsy one. One of the biggest risk flags that came out recently is a record recall of 246,229 vehicles due to a software problem affecting models like the ES8, ES6 and EC6. That recall is huge, roughly 3/4 of NIO's projected 2025 sales volume. And it hangs over investor confidence because it's not just a minor fix, it's a broad safety concern that affects a large portion of the installed base. Now, while the company isn't behind on solving it, remote software updates and service upgrades are part of the fix, recalls of this scale matter. They hit profitability, they hit perception, and they raise questions about software quality and execution in mass markets. When you're asking new buyers to adapt smart electric vehicles at scale, execution consistency becomes a competitive edge, and this was a rare misstep that can't be ignored. Here's what's fascinating about that contrast. NIO can deliver almost double the vehicles year over year, but still struggle to turn that into consistent investor enthusiasm. That's because markets care about earnings, margins, execution precision, and macro conditions, not just headline delivery numbers. In fact, NIO has signaled a potential turnaround in profitability too. Recent reports suggest an operating profit for fourth quarter 2025 could land somewhere between roughly $29 million to $100 million, a stark improvement from deep losses in earlier periods. That kind of shift matters because it suggests operating leverage and cost discipline are beginning to take hold, something bulls can lean on. But even here the truth is nuanced. Deliveries are up almost 100%. But cycles still show month-to-month softness. Deliveries in January were down compared with December. That seasonal factor isn't surprising, but it underscores that growth remains lumpy, not linear. And beyond deliveries and recalls, competition and macro pressure are very real headwinds. Tesla remains the dominant global EV force, and Chinese peers are fierce in pricing, distribution scale, and model pipelines. Execution risk in building margin and defending share in such an environment is high. So if you step back and look at the truth right now, it's not a simple bullish or bearish story. It's a mixed execution signal. Operationally, NIO is progressing. Deliveries are strong, the ecosystem, including battery swaps and software tech upgrades, continues to expand, and they've started to nudge toward profitability. But many investors are still looking for durable, GAAP-confirmed profitability, consistent execution, and clear path to earnings proof. And that's why the stock hasn't ripped higher with the delivery numbers. Now, think about where this leaves us for the next few weeks. The ultra near term hinges on how the market receives upcoming earnings, especially with a focus on real profitability versus adjusted metrics, and any commentary on 2026 margin guidance. How much margin improvement is there? How does cost discipline look? Those answers will shift sentiment quickly because they speak directly to the core question investors have. Is this growth real and sustainable, or just headline figures? The pipeline of new models also plays into this. While deliveries are strong now, what comes next? Before we continue, if you've been following this channel, you know I don't waste your time with hype or guesswork. I focus on research, real insights, and tools that can actually help investors. That's why I've partnered with The Motley Fool, one of the most trusted names in the investing world for over 20 years. You'll find my link in the description. Is the easiest way to check them out and see what they offer. That link also gives you access to special deals or discounts they have available right now. And yes, it helps support the channel too. Now let's get back to the video. NIO's vehicle lineup includes momentum builders like the ES8 SUV and expansion through Anvo and Firefly offerings. But the next generation tech halo models like ET9 and future ES9 remain a future catalyst, not yet material in numbers. The market likes seeing a pipeline, but it also wants results from that pipeline. So the truth coming out isn't a single answer. It's a tension between very real operational progress and the market's cautious interpretation of that progress. Deliveries are up, cumulative units are past 1 million, and profitability signals appear. But recalls, execution complexity, and competition are real headwinds that temper enthusiasm. That's why long-term investors see a fundamental growth story, while shorter-term holders and traders remain wary, watching price action and earnings reactions with a very close lens. When you watch how NIO behaves around its next earnings print, how the company frames margin improvements, and whether delivery momentum continues month after month, you will see which side of this truth begins to dominate the narrative. The side where operational wins finally convert into durable shareholder value, or the side where execution missteps and macro pressure continue to hold back valuation. That's the real story here, not a simple bull or bear tag, but a clash of truths that only execution and time will resolve. And that's exactly why serious investors are watching this setup so closely right now. This is it for this video, guys. Thanks for watching, and please make sure to subscribe, like, and leave a comment down below.